Hey guys, this is Mia at Effortless Mortgage. How are you guys doing? Today we're going to share with you 5 expert tips on how to reduce your monthly mortgage payment. You might have heard a lot of those headlines all over the news, how expensive mortgage payments have gotten. A Toronto Star article recently have gone even further to say, prepare for the worst. Mortgage costs have climbed by 30% and could get a lot worse. And this is actually true for people who renew their mortgage in the past 12 months or bought a new home in the past 12 months. Let's dive into our top tips. Tip number 1, extend your amortization. By extending your amortization, you are lengthening the term of your mortgage and spread your payment over a longer time frame, therefore reducing your monthly payment. First of all, what is mortgage amortization? Let's take a look at the definition on the Government Canada website. The amortization period is the length of time it takes to pay off a mortgage in full. The amortization is an estimate based on the interest rate of your current term. If your down payment is less than 20% of the price of your home, the longest amortization you're allowed is 25 years. Let's take a look at an example. If you have a $500,000 mortgage at 25-year amortization with an interest rate of 5.5%, your monthly payment would be $3,051. When you extend the amortization period from 25 years to 30 years, your monthly payment will be reduced to $2,819. That's a full $240 reduction. If you extend the amortization to 35 years, your monthly payment decreases to $2,662, almost a $400 reduction versus a 25-year amortization with the same interest rate. That's going to help you with your monthly cash flow significantly. Make sure you talk to an experienced mortgage broker before you choose this option to understand the full impact before you make the decision. So when can you extend your amortization? You can extend your amortization at the time of mortgage renewal. Mortgage renewal is a fantastic opportunity for you to renegotiate the rates, terms, everything about your mortgage without having to worry about breakage costs. We have another video that we've done recently that talks about all the things you need to consider during the mortgage renewal. We've included the link in the descriptions below. Now, some lenders also allow you to extend your amortization during your term, not just at renewal. However, those mortgages may be subject to requalification, meaning lenders have to relook at your credit and income again at that time. Tip number 2 is to lock into a fixed rate term. Locking into a fixed rate term can protect you against potential rate increases and give you peace of mind. The most popular mortgage terms among Effortless Mortgage clients right now is a 3-year fixed term. It's because right now the expectation for interest rate trends is that Bank of Canada may increase their rates, but not by much. Mortgage interest rates will likely start to gradually go down in late 2024 or 2025. So that's why a 3-year term protects you against any of the further increases that might happen in the market, but at the same time, it gives you the flexibility so that you can act when rates start to decrease and you're not stuck in a 5-year fixed rate for a longer period of time. The fixed rate terms are about 0.5% to 1% cheaper than the variable rate. That means on a $500,000 mortgage, you're saving somewhere between $150 to $300 a month by locking into a fixed rate term. When you start looking for a fixed rate, always make sure you talk to mortgage brokers that have volume discount with their lenders. So for example, at Effortless Mortgage, we work with all the bank and non-bank lenders in Canada. Because of the amount of volume we do, we always have access to the best rate specials. And from there onwards, our mortgage advisors also buy down the rates even further to make sure our clients have absolutely the best deal possible. Tip number 3 is to consider interest-only mortgage. This unique option allows you to only pay the interest portion of the mortgage for a fixed period, which is typically a year to 2 years, to help you out with your cash flow. Most of the interest-only mortgages are offered by B lenders or private lenders. Therefore, the interest rates are typically a little bit higher than the banks. Although right now there's a lot of competition, a lot of people enter into this space, so the rates are actually becoming more and more comparable and more affordable versus the bank interest rate. However, because you only need to pay for the interest portion of the loan, despite higher interest rate, your monthly payment can still be a lot lower than the interest plus principal payment that you currently have. With a reduced monthly payment, you have the opportunity to now allocate funds to other investments or financial goals. However, it is crucial to have an exit plan, because if you keep paying interest-only payments, your principal on the mortgage is not being paid down and you're not accumulating any home equity during this time period. So make sure you approach this option with caution. So at Effortless Mortgage, we always talk about the big picture, the exit strategy. So make sure before you get into an interest-only option, fully understand what are the terms, what are the penalties if you break, how do you get out of it, like how do you refinance back to an institution a year or 2 years from now when the interest rates are lower. Those are conversations you really need to have upfront to make sure it is the safe and suitable financial strategy for you. Tip number 4 is to make a lump sum payment towards your mortgage balance. If you have extra funds laying around, consider making lump sum payments towards your mortgage balance. A lot of the mortgages comes with 20% per year prepayment privileges. That means you can make prepayment up to 20% of your mortgage amount without paying any breakage costs. For example, if your mortgage amount is $500,000, you can make up to $100,000 of principal payment without incurring any penalties or breakage costs. When the stock market is good, interest rate is low, it actually makes sense to keep a higher mortgage balance, making those mortgage payments, and take out funds to invest into the stock market, to invest into higher return instruments. However, fixed mortgage rates are around 5 to 6% with the banks right now, and the variable rate are touching 7%. So by actually paying down your principal, you're saving like 6 to 7%, you're making 6 to 7% on your money, right? So if you do have the luxury and have extra funds that's sitting around, whether it's $2,000, $5,000, $10,000, doesn't have to be a huge sum of money to make a difference. Another thing to keep in mind is when you make a lump sum payment, your monthly mortgage payment doesn't automatically go down. So this actually goes hand in hand with the extending amortization. You need to talk to your bank, talk to your mortgage lender to make sure after you make the payment, they're able to extend amortization and take into account the payment you just made, extend the amortization accordingly, and therefore reduce your monthly mortgage payment. Our final tip number 5, is to consider mortgage refinancing. By refinancing your mortgage, you're replacing your existing mortgage with a new one or adding additional money to your mortgage balance. You can generally refinance up to 80% of your home value. For example, if you have a home that's valued at $600,000 and you have an existing mortgage balance of $300,000, now you can refinance up to $480,000 or 80% of your home value. So that provides you with extra $180,000 of cash you can use to help you with your cash flow. A lot of people use it to consolidate credit card debt, car loans, to bring down their overall monthly payment. A lot of the lenders also offer home equity line of credit options. With that option, after refinancing, you actually don't have to take that extra money out. Let's say in the same example, you got approved for another extra $180,000. You can keep that room, keep that open limit in your home equity line of credit and only take it out when you need to use it. That is a huge help when you need extra cash to supplement your mortgage payment, and oftentimes on the revolving portion, you can only make interest-only payments, which again helps with your monthly cash flow. One catch is that with the increased interest rate and also the tightened lending criteria from the banks, it's getting harder and harder to refinance and take out more home equity from a bank lender. That's why a lot of Canadian homeowners and home buyers are actually looking to alternative mortgage solutions such as B lenders and private lenders for help. Oftentimes they offer very flexible interest rate terms. They're very flexible in credit and your income. A lot of people who wouldn't qualify for banks, they're able to refinance and take out their home equity with a B lender or a private lender in Ontario. Congratulations, you've just learned 5 powerful tips on reducing your mortgage payments. Remember to extend your amortization, lock into a fixed rate term, consider interest-only mortgages with caution, explore lump sum payment options, and evaluate benefits of refinancing.
Learn more about your mortgage options. Visit effortlessmortgage.ca